Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, August 2nd, 2016. In this video, I want to do a comprehensive market update. That means touch on the U.S. equity markets, gold mining stocks, and oil, and try to do. I won't dig too deep into any one asset class, but we'll try to touch on everything here and look at the most important developments, things I'm watching for. All right, this is the SPY, the S&P 500 tracking ETF. This is a daily time frame chart I've covered many times recently, pointing out these consecutive divergent highs here. We have this series of 3 divergent highs, and the most recent, as I mentioned on the site, confirmed. We have a bearish crossover on the MACD as of a couple days ago, actually. So we continue to follow through. We were down yesterday, further putting the, confirming that crossover. And that's something I've been waiting to see for a while. And in a second here, we'll zoom down and look at the 60-minute charts for our timing entries. I don't have these as official trade ideas, but although I may, after this video today, I may put one or maybe a couple broad market ETF shorts, even if they're just for short-term trades, pullback trades. We'll see. This is the NASDAQ 100, which managed to just make a slightly higher high so far on the MACD and about equal on the RSI. Now, when you look at the NDXE, it's a little less pronounced. As I mentioned, there's been some divergence lately, and you can see a nice bearish crossover in play on the NDXE. And I'm talking fast here, trying to get through this video, but the NDXE is the NASDAQ 100 equal weighted index, so that just gives an equal weight to all 100, and I think it's 106 components or so in the NASDAQ 100 right now. And if I don't mention it, I'm working off a daily time frame up here. You can see in the left-hand corner. So unlike the NASDAQ 100, the NASDAQ equal weighted is still well off its, off its highs, I should say, by a couple percentage points or so. And it looks like very close, to almost equal highs on the MACD and RSI, slightly higher high on the MACD, but more importantly is that we have a bearish crossover in play, and what I call a clean crossover. I don't want to spend too much time on this, but when I look at let's pull up the MACD histogram. And the MACD histogram, as most of you know, just shows the differential between the two lines there. So when you have green on the MACD histogram, sometimes you'll see this histogram overlaid within the MACD. I like it sometimes separated out and you can see it a little better. That just shows you that the MACD line, this blue line here, is well above the, or up trading above the 9 EMA, the signal line. And when they cross, that's when you cross down below 0 on the histogram. And something, in trading, as you guys know, I like to use crosses above and below the 0 line, which is typical. That's the way the MACD is used. You can see here the trend when the MACD, particularly the 9 EMA, because that's the last of the two to cross above or below the 0 line. When that's above, the trend is bullish, and when it crosses below, like it did back here, so actually back here, that's where the cross, the trend is bearish, and it remained bearish to that point. So it does a good job as a trend indicator, but another way to use the MACD is just simply at these crossovers here. So when the MACD histogram crosses, that means the lines have crossed. Now, when using that, as with any trend indicators, I like clean signals. What I mean by clean is I like to see a nice differential between the two lines, see that spacing, and that's also reflected in the histogram. As you see these tall bars here, you can see that spacing, and then you come on down, quickly turn down, and you make a clean cross versus this whippy stuff right here. For example, back here, I wouldn't pay crossovers any attention when the MACD is flattened out, trading, sideways. It's not coming down, not heading up, and you have these crosses. That's whipsaw signals, so that's when I back away from it. However, when I see this clean separation in the lines, these bullish and bearish crossovers tend to carry a little more weight, like this one back here. Did it tell you? It got in there, got in a little bit early. Well, it got you in, but then it caught that big move. So either way, just something to point out. Again, it helps to really also confirm the divergence and everything else I'm seeing, which we'll dive into here. All right, before I move away from the daily charts, we'll look at a couple other. Did we start with the S&P? Yes, we did. We started with the S&P, then I went over to the NASDAQ, and I'm going to go to the Russell now. Small cap index. We'll skip the mid caps. Maybe touch on them briefly, actually. There's the Russell using this board. We do have divergence. We have long-standing divergence. We had a divergent high here. Like everything else, a series of consecutive divergences. And more recently, we have, you can see here, a pending, if not in effect. Yeah, we do have a bearish crossover, it looks like, on the MACD right now, the crossover in play. Yeah, you can see it on the histogram, there are little red bars. All right, let's get that histogram out of the way now. We don't need it anymore. So we do have a bearish crossover on the Russell and long-standing divergence. It's also at this resistance zone here, just a hair above it, which is still close enough. And there's that shows us that we're probably going to have at the very least a tradable pullback here soon in the small caps as well as the large caps that I just covered. Now let's look at the intraday charts. We'll look at the SPY on these because this will give you some levels that I'm watching. You can trade the S&P 500. Some of you guys trade E-minis. I know that, the E-mini futures, but I believe the vast majority of traders use tracking ETFs. So we'll take a look at the SPY, and that way you can see some targets. All right, as I've been stating for quite a while here, we've been building, we had this rising wedge, it broke down. Very unusual to see such a well-defined, steep rising wedge break down and not play out pretty impulsively. Although I've seen this before, the market, you can't say this pattern hasn't failed to play out because all we've done is go sideways. We broke down. So even if you shorted it back here, we're exactly where we were when the wedge broke down. Now, more importantly, since that breakdown of the wedge, we've had this is odd and unusual behavior. And odd and unusual behavior, the fact that we didn't go down, absolutely, because the trend is up, you could say that's bullish if the market refuses to go down. But this is not very natural price action. And either way, call it what you want. This is my trading style. I trade off these divergences. I trade off trend lines. I trade off support and resistance. So what I'm watching and have been and pointed this out quite a few times recently are a couple levels here. I moved the line around now. So what is that? 215, 30-ish we'll call it. And this trend line right here, this has really acted as a nice support level on this sideways trading range. So we have another divergent high. I know on the S&P, we certainly made a slightly higher high than this one back here. So this is our most recent divergent high. You can see it on the MACD. Yes, I've been pointing out divergence since back here. I've been pointing out since back, actually no, correct that. We didn't have it, I don't believe, on the NDX, or a couple of them we didn't have during the wedges. We had it afterwards at this point. That's where the divergence started forming. It's only gotten bigger, which only reinforces my case for a tradable pullback. By tradable, I'm talking something that will last more than just a few minutes. In other words, more than an intraday trade going hours or minutes. This is looking at likely a pullback for at least a few days. These are all support levels here. And I would have to just tell you right now, my preferred, even though we do have a reaction high there, at the very least, I'm looking for a pullback to this 210.83 level. And I can tell you this, that I'll probably wrap this video up and put it as an official trade idea. But official, unofficial, I think the risk reward to being short here, especially once that level goes, once you have the trend indicators confirm, as you guys know, I like to see the MACD signal line, this white line cross below the zero line. You can see it's pointed lower right now, both the MACD and the signal line. Even though they're flattened out, they're pretty compressed right now. Hence that's why you don't see a lot of histogram bars here, because they're trading very flat. However, it's made a lower high. It's turned down and made a peak right here, and the histogram's about to cross. Everything's pointing down, so this looks about as good as it gets, guys. And I know it's been frustrating because the markets look like they should have rolled over back here and they didn't. But again, even if you were short, as long as you have patience, and that's everything in trading, patience and discipline. Discipline being that if you shorted and this thing just ripped higher and whatever your stops were, or if you short here and you short this breakdown, quantify your stops. If I make an official trade, I will put some suggested stops, and if I don't, everybody has different takes on where this market's going. We have certainly seen a deterioration in fundamentals recently, yet the market continues to ignore that. So for those of you with a bigger picture outlook that think there might be a lot more downside, then you short and you trail stops down, or you play stops where you short and you can let it ride and let your profits ride. And if you just want a quick pullback trade, or you're bullish and you want to go long, these are the support levels I think we'll see a reaction, and this is a pretty important one. I mentioned already on the site the other day how low the short interest is, and I've seen that in the past. Low short interest is dangerous. Dangerous because you don't have those natural buyers in the market. You don't have a lot of shorts that are going to cover on these levels. In fact, being that most of the shorts are now blown out, you're going to have more than likely new short sellers step in and short at those levels versus those that are already short covering when we get there, if that makes sense to you. All right, so NASDAQ 100, the Qs, same story. See here, we didn't have that divergence when the wedge broke in the Qs. You can see we put a higher peak in. However, we do have divergence now. So the Qs had this sort of a bearish rising wedge channel, unconfirmed by divergence. Wasn't confirmed here on the histogram, wasn't confirmed on the RSI, and was not confirmed on the MACD. However, after that breakdown, we continue to move up in a pretty well-defined ascending price channel. Put in a divergent high. This most recent high was a divergent high because you can see the lower highs in the MACD, the RSI, the 1333 trend indicator. The Qs are the healthiest of most. By that I mean they're well off giving me these 60-minute trend indicators flipping to bearish, because we have to see this histogram go below the zero line. We have to see the MACD. However, we're going to see it on the SPY almost certainly on any more downside. And let's take a look at the IWM. And where I'm going with that, I think the Qs will probably play catch up to the downside. IWM, again, these are just clean patterns. You look at the 60-minute, very well, these trend lines in this trading range, pretty well defined. So my expectation, I stated this yesterday in the trading room, is, we had a little intraday rip, and was it Al Shaw mentioned that shorts didn't or came in and covered real quick. That was just intraday noise. What I'm watching for is, see, all this has been intraday noise, chop. I'm watching all these trend lines, and what's nice about this, and this is why I used all various broad markets in my analysis. I don't just focus on the SPYs or the Qs. What I'm noticing is when one breaks, they're probably all going to break together or within very close proximity. And then to help validate these trend lines or these little patterns that I'm watching, you want to see impulsive selling following that. And you can see the levels are pretty well defined on the IWM. There's this gap right here. At this point, you have a reaction high here. So this is a target zone, an initial target zone. So let's say you're gun shy. Well, there's two type of traders. You're either long or bearish or bullish. If you're neutral, stand aside, no problem with that. But let's say you're bearish and you want to short. There's still from this point, if this line breaks, we're right on it now. So I'm going to try to grab it here and just measure this out for you. And I would target it. I would favor the bottom of that support zone. So that's 1.8% if you looked on the box to the left. Now you can, as a short-term trader, go ahead and use TNA or TZA, the 3-time leverage short, because you're not going to be in it very long. I expect a pretty swift move down there. So you take 1.8 times 3%, and you have a pretty decent trade that would probably hit that in just a day or two. No more than 3 days, my expectation if we break down. Backtest is possible, but again, based on everything I've seen, I think the breakdown this time will come pretty quick once we break those levels. And then here's the million-dollar question. Do the markets find support? I favor a move down to this level here. There's a gap and a reaction over here and another gap, and that is 117, call it, on the IWM. But remember, there is a lot of short interest, or there has been a lot of short interest cleared out of this market. We're at record lows in a lot of leading stocks. And, very often in those situations, what happens whereas in a normal market, whether it's uptrending, downtrending, you get a pullback, you get reactions off these support and resistance levels, even if they're fleeting, meaning come down. A reaction is a pause and or consolidation or a bounce. So we can pause, consolidate there for a little while, bounce. But when short interest is cleared out, it's not unusual to see at least these initial levels just get smashed through like they're not even there. Maybe a very brief reaction lasting just a few minutes. So that's something I'm looking for. And those are my near-term targets. So, 117. And so to take it down from 120.71 roughly down to the 117 level, that's 3% in IWM or 9% in TZA if you're going to take that. If you can short TNA, that way if you're stuck in the trade for a little bit longer than expected, you have the decay working in your favor instead of against you. And you can see these trend indicators are just, any downside. Once these trend lines break and there's any downside, you're going to flip to bearish trend indicators. And you can see we've been bullish all the way from back here on these trend indicators. And you see how the white line crossed right there where the crosshairs are. The histogram crossed green at that point. And this was your last sell signal back here after this extended uptrend here, or bullish signal. And that one played out for a pretty good move down. So and also keep in mind, I don't use these as standalone buy. They help confirm your entries, and however, I should say they will help confirm this breakdown here, and you can see the posture that they're going to confirm. But you don't trade these standalone. You use, for example, when you get a sell signal like you did back here, you want to exit at support, especially if you see bullish divergence or something like that. And so where I'm going with this right now, this has been an extended uptrend, and I can't even tell you right now where my final targets will be. I told you where my initial or preferred targets are, but if this morphs into something else, then we'll just have to watch, maybe look for some kind of move down to support, one of these other support levels, and then at the same time have that confirmed, either a selling climax, a candlestick, some type of reversal pattern, maybe bullish divergence on the 5, 10, 15-minute chart, something like that, and or all of those things put together. But also remember that if these patterns start playing out pretty impulsively, that will start to do some damage on the excuse me, folks, on the long-term charts. And again, so I not only factor in all these different indexes and try to make sure that each one is confirming the other. Each breakdown is confirmed by a breakdown in another major index. But the fact that the bigger picture says, should those 60-minute charts play out, then we have a failure here at a major resistance zone, and we also will have confirmed this negative divergence on just about all of the major indices. Now this plays out for a move measured in weeks, if not months, these large divergences. That is the point I'm trying to impress. So this is a case where I say the charts are stacked, because we can focus in on these 60-minute charts to kind of hone in on our entries and exits. Hope I did something wrong there. There's the 60-minute chart. This helps us hone in on our entries. And like I said, we didn't have the sell signals. We were very close for the last couple weeks. I kept pointing that out, but they weren't triggered. But they're by the time you watch this video, they will be. So let me wrap this up. And 17 and a half minutes into it. Let's leave it here. Let's leave this one equities only, and then so I can get this out, and then I'll just talk on gold and oil in another video, and that way we'll keep this one under the 20-minute mark. And again, if you decide to trade these before they're official trade ideas, or even if they're not, those are the target levels. Feel free to shoot me questions via the comment section on the front page or in the trading room. This has been Randy Finney with the Right Side of the Chart. Hope you enjoyed it.